What up, what up, what up? It's your boy, the Options Boss. Just sliding in with another video for y'all. Hopefully y'all enjoy the video so far. Talked to a subscriber of mine. He let me know that he needed me to explain how to close a position, a call or a put on an option. And he wanted me to explain a little more in depth how you make money on that call or option. So we're gonna slide into my Robinhood today, and I'm gonna help you guys figure that out. So as you see right here, I have RCL calls, 6150 strike. I have 15 contracts on them. The average per contract is $1.08. That's how much I paid for it. That equals $108 per contract. And right now they're currently worth $1.14, which is $114 per contract. Right now I'm making a $90 profit off of them, which is a 5% win if I were to trade it right now. So what I'm going to do is I'm just going to walk you guys through the process of how I would close this position. So on the bottom right hand, you'll see a button trade right here. I click on trade, then I will click on sell. And once I got to sell, up top, the first line you'll see contracts. So I have 15 contracts. However many contracts I was trying to sell at this point, I will put up here. So let's just say I'm closing out 7 of them. I would type in number 7. The limit price is how much you're selling the contracts for. So Robinhood will always show you like the number that the contract is worth currently. Once you get to that line right there, it says $1.14. Now from here, if I were dying to sell this position for some reason, you would take the price down a little bit. So maybe you would go 1.13. And then Robinhood would sell it for $1 cheaper. This would enable you to sell the contract almost immediately if you don't want to wait. I wouldn't advise this except for extreme circumstances. So hypothetically, you could sell it for the market value price of $1.14. What you would do is you would click that green button. This is after hours, so it's not going to go through. But you'll see Robinhood tells me I'm selling the right to buy 700 shares of RCL for $61.50 each by July 17th. And the reason why 700 shares is because it's 7 contracts, and each contract is 100 shares per contract. So from there, if I were interested in doing this, I would swipe up, and that would essentially be the confirmation of the trade. I'm not going to swipe. Well, I'll swipe up because it's after hours, so nothing is going to happen. And you'll see Robinhood is sending the order, and it'll say my order is quayed right now because it's not filled. Hypothetically, if this was during the trading day, they would tell you guys that my call order has been filled. As you see, it says markets are closed right now. So at that point, you would be done. Now also, I'm going to show you guys something. Also, if you want to sell, but not at the current price, but you feel like the stock is going to keep going up, but you don't want to watch it all day, you can go to that same sell, and let's just say we're going to do 1 contract just for now. And in that price of $1.14, you could move it up. So let's say I think RCL, I said that correctly, RCL. Let's say I thought that was going to go up. So I would go 1. Let's just say 30. And then I would do the same process. I would click that and I would swipe up. And what's going to happen is, even if I'm not on Robinhood, even if I put my phone down, etc., if RCL hits 1.30, this contract is going to automatically sell. And if it hits 1.30 and it sells and then it goes to 1.45, well then I just didn't get my max profit. But this is a good way to do things if you want to if you're not able to watch that exact contract or that exact ticker at the time. And all these sales that I'm doing, I'm going to cancel these when the video is over. I just wanted to walk it through the process from closing out the position so you guys can understand. Now, with that being said, to elaborate on how to make money from the call or the put? That's very simple. If you grab a ticker and you think that it's going to go up for the day or days or weeks or whatever the case may be, you would grab a call. When you grab a call and the price goes up on that ticker, let's just say when you grab the call, the ticker, let's just say it was RCL. And I believe RCL was around $58 or something along those lines around close. So if you grab RCL and it's around $58 and RCL starts to go up, the further RCL goes up, the more money you're going to make. And that's on a call. And on the flip side, if you were to grab a put on RCL and it's at $58, the further down in price RCL will go, the more money you will make on that put. Now, the things you have to be careful with is expiration and the Greeks, and those are very big things. If you're not familiar with the Greeks, let me know in the comments. Maybe I'll make a video about the Greeks eventually, just to kind of give you guys some information on that. But those basically the ways you make money on a call or a put. Essentially, you want it to go in the direction that you chose. As long as it goes in that direction, you'll make money. Even if you buy an out-the-money contract, I know a lot of the quote-unquote pros, they don't really like to get into out-the-money contracts. For myself, for the right circumstance, I'm fine with an out-the-money contract. If you buy an out-the-money contract and that particular ticker makes a strong move in the direction that you're hedging for, whether it's a call or a put, if it makes a strong move in that direction, even without the money contract, you're going to make money. And the reason why, in some cases, I prefer an out the money contract is because, contrary to what popular belief is, it actually lessens the risk of how much money you'll lose, because an in the money contract is going to cost you more money. You're going to pay a bigger premium because it's less risky. But an out the money contract, being more risky, will cost you a smaller premium. So you got to kind of weigh the risk reward of, do you want to go more safe and pay the bigger premium, or do you want to go more risky and pay the smaller premium? You have, if you have a good catalyst, I'm a big fan of catalyst. You guys will hear me mention that. If you have a good catalyst on a ticker, then definitely go with out the money and let it run up into your price. I'm a big fan of that. I made a lot of money that way. I've started my account with $50, and here I am now sitting up in the high 40s. So you definitely can make some good money that way. That being the case, I hope this video is informational for a few of you guys. Let me know in the comments down below. Give me a like, give me a subscribe, and I'll definitely holler at you guys. It's the Options Boss.